I'm going to welcome here to the stage a gentleman that I know most all of you who have attended our summits in the past are familiar with. Marshall Sonenshine is not only the co-chair and co-curator of this summit here today, but also together with Jack Butler and Selig Sachs, great guides and leaders through the development of both our publishing and our forums. I've said it once today, and I won't be the last one to say it, that we have climbed over the hurdle and set a new record for M&A volume. And while that is a feat unto itself, I think in this next session it's going to be important for us to look at the role that private equity is playing in driving M&A. It's a global multi-trillion-dollar force, and from leveraged buyout funds of the 80s to the modern multi-strategy private capital firms, private equity and M&A have been intertwined disciplines for over 30 years now. So I'm going to ask Marshall Sonenshine to lead a keynote conversation with two individuals who are playing a pivotal role in the ongoing development of private equity in the mergers and acquisitions community. Marshall Sonenshine, who's the chairman of Sonenshine Partners, here together with James Attwood, who's the managing director and the head of global telecommunications and media for the Carlyle Group, and Steve Klinsky, who's the CEO of New Mountain Capital, currently a $15 billion fund, and with more to come. So with that, Marshall, I'm going to turn the stage over to you.
Thank you, David.
Thank you.
Thank you very much. I'm somewhat, not quite intimidated, but somewhat humbled by the task here. It's got to be Keynote. These guys are pivotal. I'm a curator. This sounds very robust and august, so this better be a damn good conversation, guys. Let me start with that. I'm also somewhat humbled because I have a lot of bosses in my midst. First of all, David feels a little bit like a boss because he runs the damn conference and he's always asking me to get involved. Secondly, these guys sometimes feel like a boss because they're clients. And thirdly, we might be interrupted by Tom Keene from Bloomberg, whom I was on air with this morning, and he says on air in front of everybody, we're talking at the M&A conference later this morning, right? So I call David and say he's coming. So if he shows up, guys, we're off the stage. That's it. Let me start with maybe a quick introduction. You guys are from very similar backgrounds in one sense and slightly different current perches in another sense. You're both, in my judgment, and I'm going to say this without apology, you're both class act, best of breed, first tier guys in the private equity world. You know that. You both are. Steve, you're a former partner in the iconic Forsman Little organization, which was one of the trailblazers and really unique players in the pantheon of great private capital management organizations, if I may say so, in the last 20 or 30 years of American business. I think that's fair. And you went off and founded New Mountain Capital, now $15 billion. It is a multi-strat fund. It's privately held by you and your partners, but it has many different businesses, and including private equity, some credit, a BDC, Business Development Corporation, and some public hedge fund activities, and maybe other things too that I'm not yet aware of. And Jim, you ultimately emerged as a partner in one of the most interesting, and I'll use the word again, iconic, of American businesses and global businesses, and that's the Carlyle Group. You're now maybe becoming a senior partner because we're all aging, and you run one of the most dynamic parts of the portfolio of activities in media, telecom, and technology globally. So you both have what I would call a window on the business world that matters. So let me first ask you each to talk a little bit about your window and how the world looks from your window, and then I'll ask a few more specific questions, but I want to let you guys free associate a little bit, as I know you creatively and eruditely can do. So Steve, tell us a little bit about your perch.
Well, and thank you, Marshall. Thanks, your very nice introduction. At my seat as CEO of New Mountain, we have three types of funds. So we have about $11.5 billion in private equity more middle market companies. The average median enterprise when we buy them is about 500 million. And we try to find acyclical, consistently growing companies. A lot are in software and medical devices and technology-enabled business services. We have a $2.5 billion hedge fund, and we have about a $1.3 billion debt fund. So, my perch really is not so much trying to figure out the world at large, because we figure we're going to hold companies for 5 years and then have to think about the next 5 years, and there's going to be all sorts of cycles. We try to figure out the world at large, but our basic strategy is find the niches that will grow consistently, whether the macros are good or bad. We call those defensive growth niches, and I can talk more about that later.
Good. Jim?
Yeah, well, my perch is also an interesting one, both from an industry sector perspective and also from a firm perspective, as you mentioned, Marshall, and thank you also for inviting me to this panel. Carlyle is one of the larger private equity firms. We have over $200 billion of capital under management now. When I joined the firm in 2000, that number was 13. So there has been some growth in the last 14 years. Always been focused on telecom and media, and more recently technology. It's a sector that's very dynamic, but also very challenging as an investor. Not for the faint of heart at times. We've since the inception of the firm invested close to $20 billion in the sector, broadly defined around the world, and about half of that in the last 10 years or so. So it's an area that we continue to be very focused on. But we're fortunate because the way our firm's constructed, we have regional funds which are regionally focused. We have funds that are focused more on stage of growth, so buyout and also growth capital. And then within our large funds, like our U.S. buyout fund, we have industry sectors. So there are times when we're very active in a given sector and other times when we're not. And I like that sort of internal diversification for us. For example, in Fund 3, TMT represented about 50% of the equity that we put out in that fund, whereas Funds 4 and 5, we dropped that down to about 15%. And we've only really done a handful of deals in the last couple of years because of valuation and other market dynamics.
So let's go right to the problem of valuation and the related phenomenon. I think you guys will agree with me that if 2014 is the year of the resurgence of M&A, I think we could call M&A the last to recover of the major financial markets post-2008 crisis. But if 14 has been a year of renewal, recovery, and resurgence, it's mostly on the big corporate side. It is not really yet on the private equity side, maybe because of pricing. Just yesterday, and we had 2 major flagship deals, which is why I was back on Bloomberg today talking about Activist Allergen in the pharma sector. That's been a very hot sector. And Halliburton Baker Hughes in the oil services sector. And in both cases, you have very, very expensive targets being bought with a lot of stock, somewhere between 40 and 75%, depending on which deal you look at. So is M&A today a big corporate gain to a much greater extent because of valuations and a private equity gain? Has the game shifted a little bit now?
I would say in the traditional telecommunications and media sectors, yes.
Yep.
Those 2 areas have been probably the most active, certainly in the first half of the year, with most active with very big deals, AT&T, DirecTV, Verizon, Vodafone, Time Warner Cable, Comcast, et cetera, et cetera. And that's all been strategic. We really can't play. We're not going to outbid AT&T to buy DirecTV, of course. But the interesting thing I'd say, Marshall, is a decade ago there was a lot of similar activity in the sector. And what then subsequently happened was there was a rationalizing of these portfolios when all these big companies got put together. And I would say in the last decade, that rationalization has taken place by the companies themselves. So I don't expect to see a lot of sort of follow-on smaller private equity deals, at least out of the traditional telecom media.
And Steve?
Yeah, and I would agree that I think it's the big corporations that are really dominating the M&A scene today. And I think it's a shift from different decades. So I was a partner at Force Modal when we were involved in looking at RJR and Nabisco and Barbarians at the Gate and all that. And the private equity firms at some periods were the major drivers of M&A. I mean, now I think it's clearly the big corporations. The deals are huge, and their stock. As I look just on my iPhone, I guess Halliburton stock has been hit some today, but Activist is up. A lot of acquirers have moved up. And as I understand it, Activist is borrowing $37 billion of debt at 4.25% interest. So you can afford to pay a pretty high multiple. I mean, if you're a strategic, what I've seen is the corporates can pay the most by far because their cost of cash is such a low yield, their cost of borrowing was so low. And it's just a question of when they're ready to strike, and then they can effectively pay very, very high prices and still be accretive to their own income statement.
And is the problem, Steve, for private equity that cheap capital benefits all private equity players in acting in competitive tandem with each other in any deal, so it isn't really a competitive advantage for anybody?
Yeah, well, I think that's right. I mean, and I'm sure Jim and Carlyle have their own approach. I mean, my own firm tries very, very hard to not buy things in auctions. We haven't bought one company in a sealed bid auction because when we have gone down into those processes, the price at the end of the day gets so high, we don't want to pay it. So my own firm's strategy is to stress the ability to build the company after we own it, and particularly do well with entrepreneurs who want to keep a minority piece and have a control partner who can actually,
and I think you guys,
and distinguish yourselves from just waving the checkbook, because it's pretty dang hard to wave a checkbook better than other people.
It's very hard. I think it's precisely for that reason that Henry Kravis 20 years ago said, please don't congratulate me when I buy, only when I sell.
Right, I try to teach my folks that.
You guys are a little bit, I think, like Warburg Pincus in that you're less dependent on debt for making your investment decisions, and I think maybe a little bit more focused than most private equity shops on how are you going to change this business, or why do you believe in the thesis at the inception?
Well, we have a line that private equity is a form of business, not a form of finance. We haven't even used debt in half of our acquisitions, and we have always used less debt than we could have used because we think we're buying a company, having a strategy for it, trying to build the enterprise, and then we use debt as a sweetener, but just as a corporate finance tool, not as a drug to tell us to buy the company or not. So, and I know Carlyle has done a lot of similar things. So.
But Carlyle is a much more complex animal, Jim. It's got many tentacles into many markets, and it operates at many different levels of play. Is there any way in the robust Carlyle platform to somehow synthesize a perspective about debt, as Steve just did for the New Mountain portfolio?
Well, I can't say across the entirety of our businesses. Let's just say in our private equity business, I say our style is relatively consistent across all of our funds and platforms, which is we do take leverage. We're rarely the one who takes the most leverage that the banks offer, but levering our returns in this environment is really the only way to get to our 20% plus target. But I'd build on what Steve said, which is we're always looking for angles, because plain vanilla auctions, we never win. Every once in a while we play in them just because it's a sector we know very well, or we get tempted. But unless you have an angle with a management team, an existing portfolio company, some different view that might be contrarian, but view of the market or the strategy that you could do with that company, you just can't differentiate yourself. We do find, maybe a little less so than Steve, but we do find we like to build on companies that we've made investments in. So, for example, we were an early investor in Nielsen, and last year we bought Arbitron, which was a terrific add-on, because that's where we can, most of the time we can't compete with strategics because we don't have synergies, right? And that allows them to pay more or certainly to do more interesting things. And so if we do have portfolio companies where we can actually build upon an existing position, and we did that again with a little esoteric company we own called Cineverse Technologies, bought a couple of its competitors, one in Europe, one in Asia. That allows us to create some synergy value as well as broaden the platform and grow it organically. And ideally, we do that, with the debt capacity that's been created in the company itself, so we don't have to put more equity in.
Well, let me pivot a little bit, since you're a tech guy, Jim, if I may, to the subject of legacy technologies, where sometimes buyout opportunities can be had because public markets have a funny way of underappreciating a legacy technology, assuming the tail is shorter than it might be. And I'm thinking in particular of Dell last year, which was the motherlode of all going private deals. I've said to my students at Columbia, understanding leverage finance is a necessary but utterly insufficient ingredient to success in private capital. You need to know it, but you need to know a lot more than it. When you look at legacy businesses like Dell, where you had, in that case, a declining franchise on the computing side, and an amalgam of enterprise software and services businesses of some $13 billion worth that had been accumulated on top of it, is that where you tend to find value, where there is something that has gone wrong in a public market sense and everybody has said, bad idea, except somebody wants to be the contrarian private equity guy that says, good idea?
Well, I do think there is a class of legacy technology companies that are quite large and quite rich in cash flow, which are interesting to think about and look at. And I'd maybe put HP at the top of the list. Not that that would be a private equity buyout; it's way too large. But it's an example of a company that had, traditionally very, very strong positions, still does in many of its markets, but also to some degree lost its way and certainly has lost favor in the public markets. So we do look at that class of company because there's size, there's scale, there's cash flow, but you have to be very, very careful about deluding yourself to think that we're Carlyle, we're going to just march in here and miraculously fix this company that somebody's been trying pretty hard to fix for the last umpty-ump period of time. So I think it's an area. The other thing I would say about legacy technology is it's been very fertile ground for activists. And so the activists have been creating a lot of deal flow. I think most recently Tibco, Riverbed, other, they're sort of companies that are out there that, are not trading at crazy multiples, that have cash flow, have good entrenched market positions, but the activists are coming in and really stirring the pot. And the folks out west just don't like it at all. They want to get away. They want to get away from the activists. And so I think you're going to see a continuation of that trend here over the next, at least near term.
But did the activists, which was really Icon, in some ways maybe have a point in Dell?
Perhaps, although Michael Dell disagreed. We decided not to take a hard look at that situation, but that was our own personal decision. And my understanding from the Silver Lake guys is that initially it's off to a decent start. The challenge with those, when you buy a low multiple business that you're betting on a certain decline curve of cash flows, is if you bet right, and the market's assuming it's all going away in 2 years, and you say, no, that's 4 or 5 years of decline. There's a lot of cash flow embedded in that decline curve that can pay off a lot of debt.
I think maybe the problem with Dell is that it was hard to predict because in the final analysis it was about consumer taste and preference and how long it would go on for, whereas other legacy technologies can often be stickier because the barriers to entry for competitors are a little bit higher, and the pace of change or adoption of new technologies might be a little bit slower. Since you mentioned activists, I have to imagine, Steve, that both of you bump into activists in the course of looking at companies, certainly public companies, and they're sort of a strange breed in the world of M&A and private capital. I'm thinking a little bit about Ackman's. I'd like to make the pun and say it was a valiant effort by Valiant, but I think it wasn't such a valiant effort, except he made a couple of $1 billion trying, so who could argue? What's your own sense of the role and world of activism?
When I talk about our $2.5 billion of public equity, a good portion of that is under the governance mandate of some of the big state institutions. So we are classified ourselves as an activist, but we do it in a very kind of low-key, behind-the-scenes business building value. And one example would be of some years ago, there was a gas utility out of Buffalo, New York, that owned 1 million acres of land in Pennsylvania, never did a reserve report, never drilled 10 shallow wells a year, and when we added several $1 billion of value just by working with them and actually turn it into one of the biggest land holdings in the Marcellus Shale today. So it's that sort of activism. But so I think the basic idea of being a public shareholder who can also add value to the company that they invest in is a clearly alpha-generating idea. And it's just a question of how to have enough credibility with the management that you can actually have good ideas and have them implemented. So it's kind of a form of private equity without having to pay a control premium. And it gets you out of efficient market theory where you're just gambling at a casino. It's like picking up the roulette ball and putting it in the slot instead of gambling. So I think activism has a real sense, but just being angry, writing angry letters, being critical is not really constructive. That there's all different forms of it.
I'd like to coin a phrase right here and now, and if it sticks, I'll be very happy. My friend Art Laffer created a curve. I'd like to create a finance term called constructivism, which is basically what you just said. It's activism without the shrillness. You can have good. I think Icon was actually right about a lot of what he has said about a number of companies, but it depends on how you say it sometimes.
Well,
or in what circles you say it.
And Warren Buffett has a great reputation as a public stock investor, and when he owned stock in the Washington Post company, he advised Katharine Graham for years behind the scenes. And so, there's a well-established pattern of people doing this, and it's a question of how you present yourself and how you handle yourself.
Jim, what's your own take on the world of activism from where you sit?
Well, I do think there's a role in the market for it because I do think they shine lights on areas that need lights to be shined on them. But one of the reasons I worry about it a little bit in the technology sphere is because the playbook seems to be come in and cut a lot of cost, which may be a good idea, but cut a lot of R&D, which may or may not be a good idea in technology. You can certainly maximize or increase cash flow in the short term because these R&D budgets, maybe they are bloated, but I worry that it's taking a sledgehammer to the problem when you may have to be a little bit more delicate. So I guess I have mixed views on it. Particularly on the technology side of things.
Let's talk a little bit about the global financial landscape that we're now in. I think we probably would agree with the proposition that the financial crisis was made in America and the recovery is strongest in America. I think the French president, Valéry Giscard d'Estaing, accused America of having an exorbitant privilege because we were the reserve currency. I think we still have it. Are we in a good recovery mode in this country, and are we leading a global recovery, or is the globe too fragmented and troubled right now to say anybody leads anything?
Well, if you want me to start, again, our whole strategy is to try to pick the companies that are non-cyclical. So I don't really have a good take on like a box packaging company to know whether things are turning aggressively or not. We're trying to avoid those cycles. My own sense is not that it's all that robust a recovery in the U.S. It feels reasonably fragile to me, and certainly Japan just announced they're back in recession, and
Yep.
Europe could be facing recession again, and China's slowing, and so I don't feel it's a super bullish time, but U.S. maybe is I think the best house, and the metaphor, the best house in a bad neighborhood because everybody else is doing worse than us, but it isn't because things have been roaring ahead from what I could tell.
Is that your take, Jim, also?
Yeah, we do have a broader array of companies, and we try to gather data from them and look at it periodically, and track a couple of economists on staff and track it relative to public economic measures, and it seems to be consistent with this expectation of 2.5% to 3% GDP growth here. Europe is still really in trouble, but the irony there is we've been very active as an investor in the last 18 months there because prices are 30% below where they are here, and there's still some pretty good companies and some pretty good markets over there. And similarly in Japan, we've been very active in the last year and a half, even though the market or the economy's been moribund. So I look at it through two lenses. You think, of course, we want robust economic growth around the world. That'd be great for everyone. It would raise standards of living, but it does create opportunities when there's a little sputtering.
So let's talk a little bit more about Europe. David Cameron has a little bit of a question mark hanging over the UK as to whether it even remains affiliated with the EU. I think it will, because I think they've all made the right choice for them in not joining the currency to begin with, which I think we now know what we should have known. It was a failed experiment. When you look at Europe, you really have to divide it into different markets. I think UK and Germany at the high end, and you got the southern at the low end, and sort of France is a bit of a wild card right now in the middle, which is not looking very healthy. What gives you confidence to invest in Europe today?
Well, as I said, there's still quite mature markets, and again, for us, a lot of it has to do with valuation. You can still borrow at relatively cheap rates, and so you have to pick your spots ultimately. Like in any investment, you're still evaluating the market, the opportunities, the growth profile, the profitability. But we've just seen the opportunities that we find attractive there. And I don't know whether it's a confidence thing so much as Europe's not going away.
It's not going away. I think it was David Rubenstein, your boss, who once said in the press, "It's a wonderful place to go on vacation, not so good for doing business these days." I'm paraphrasing, but I think reasonably well of our mutual friend here. Steve, you guys, I think, have a U.S.-centric portfolio. Am I right?
That's right. We bought one company recently, headquartered in London, but they're a global company, and their big growth market is North America. So we're not trying. We don't have European offices trying to buy European-only companies.
If you can make money in Ohio, there's nothing wrong with that.
If we can make money in Europe, there's nothing wrong with that either. It's just our focus and our expertise are more domestic.
But the companies that you buy here in the good old US of A probably have plenty of factors and dynamics that are global.
Well, it's very global. One of the things we can do, because again, we're buying, the $300 to $500 million type company traditionally, very often they're not experienced selling globally, and we can really help take them globally as one of the upsides that we can deliver. So we're incredibly focused on selling around the world and doing business around the world, but ideally we would like the company to be headquartered in our office on our own floor where we could see management, every hour of the day, and then the next floor in the building would be second best, and the further away, the harder it gets.
That by itself is such a wonderful segue into our last topic before we open it up for questions, which is how private equity has changed. If you went back 20 years ago, it was not unusual to hear folks in private equity say, if we have to get involved in management, something has gone wrong. And I think today, people in private equity start with the proposition, we need to be involved in operations, we need to be close to management, we need operating partners, we need industry expertise, we need, because as you said, this is about business, it's not about finance. Talk a little bit about how the industry has changed in your generation.
Well, I was co-founder of Goldman Sachs' original private equity group in the early 80s when it was two people, a vice president and myself as an associate, and then Forstmann Little, when I was there as the second biggest firm in the world, had 5 professionals, and I think we grew to 8 by the time I left 15 years later. So the real growth in private equity has really been from basically 99 to 2000. I mean, places like Carlyle emerged as real institutions, and KKR was about much, much smaller 15 years ago than it is now. And I think it's healthy because one thing that's evolved is to understand you really do own companies, and along with bringing money to the company, you should be bringing management ability and strategic ability and other things you can help the entrepreneur with, particularly at this mid-market level where a guy might have built his business for 30 years, gotten as far as he could get it, and you're going to help him take it to the next spot. So it's not lending money with covenants, it's buying companies and building companies.
I don't know if you realize this, but you're actually the third New Mountain partner to speak at this conference. The first 2 were also invited by me, Harry Doherty and Bert Notini, both of whom are great operating partners because they've run businesses.
Right, and they're exactly what they help us do. So I mean, I just think it's fundamental to the whole definition of private equity today, and the firms have grown much stronger, and some of the best executives in the world are leaving traditional public companies and joining private equity firms, and I think that's a good thing.
And Jim, Carlyle is part of the ultimate revolution in private equity, the creation of publicly traded private equity firms. So talk a little bit about the big picture, how the industry has evolved in your day.
Well, I do. People often ask us, so how has being public changed what you do? And my answer is it hasn't changed. There was about 3 weeks of estate planning before we went public, and then everything went back to the same. So, we are a group of people who are investing a $13 billion fund right now, and it's the same team that did the last fund and the fund before it. We're buying the same types of companies and taking the same strategies and creating value there. It's just that the firm itself has a larger footprint, and there are perhaps more things for the public shareholders to focus on, but my job hasn't changed really at all. We also subscribe to this idea that you have to add operational improvements to a company because you can't. Everything's priced almost to perfection, and certainly priced without a lot of wiggle room. You just can't make money on the price you buy the company at. So every investment we make, we've got a 100-day plan, we've got a value creation thesis. We have, in a perfect world, we'd like to buy the company that has perfect management team and we don't have to touch them. That would be great. It just rarely happens because there's a reason why the company becomes available for sale. It's usually there's some managerial or strategic or other reasons that have to be fixed. But our approach, is similar to Steve, is we've always had the view that we're going to take deep industry knowledge. We've always had industry-focused sectors so that we can at least make pretty good investment judgments based upon the industry and the company itself. But then it's all about operations and having a team too that can react to changes because invariably things are going to come up that you didn't anticipate over a 5-year investment.
So within this more competitive price to perfection industry in which you've got to roll up your sleeves and get involved in real business, Do we have too many private equity funds vying for the privilege of trying? And should we? You guys are both top quartile players, consistently, sometimes even top decile players. Would this industry be better off if the bottom quartile just dropped away and went away and nobody missed them?
I think Jim and I should be the last two firms. So anybody, if you all want to retire out there, just send your deal flow over here. And, I think it's,
Are there too
everyone
many
should
funds?
be in it who wants to be in it.
Yeah, I understand it's a free market, but are you constantly battling too many funds chasing too few deals is really what I'm asking.
Again, our own approach is to find the owner decision maker who really cares about what happens to the company after the sale and distinguish ourselves on being the better partner going forward. So, there's always, I've been doing this now for 33 years, there's always competition for every one of those 33 years. It always feels competitive, and I think you just have to drive your own track. So I don't think that much about trying to get people in or out of the industry.
Yeah, I mean, my guess is if a third of the industry disappeared tomorrow, it would be just as competitive as it is today. I do know our limited partners are trying to reduce the number of GPs that they support, so maybe over time there might be a slight reduction. I don't know what the stats are, but people, it's a very entrepreneurial industry. People are starting. I had a couple of folks on my team spun out and started trying to start their own thing, and I applaud them for that because I think it's great if that's what you want to do. But our core business is all about trying to find those opportunities where maybe they aren't as competitive. Maybe it's even, we just announced a deal a couple of weeks ago that was actually a proprietary deal, a company called Dealogic, where we approached the owners and we said, we'd like to buy your company. And they said yes, and we signed an exclusive, and we signed the deal up. We haven't closed yet. We're closing in 2 weeks. So it still happens.
You mentioned stats. Is the private equity industry becoming more transparent because of the phenomenon of publicly traded companies like Carlyle and KKR and others, and the fact that everybody's now got to register with an SEC that's now starting to hover a little bit, whether it's over fees or how private equity firms compete with each other or don't compete with each other? Is this industry becoming more transparent to the LPs who go shopping?
Well, I think the LPs are, over the years have become more and more rigorous and more demanding transparency.
As they should be.
As I think they should be. And so I think clearly the LPs are very sophisticated, extremely knowledgeable, and even if you're not a publicly traded firm, they basically know everything they want to know or there is to know. And they're the investors, and they should.
Very sophisticated. I would say the level of our disclosure and interaction with LPs over the last decade or so has increased dramatically, or perceptively.
It would have to because of your scale, and also because in both of your cases you represent the blue chip LPs. And I think that something I've noticed in the research for the past 7 or 8 years that I've been teaching the subject at Columbia, the better you are as a GP, the better your LPs really are. It is a pretty efficient market. Let me use our last couple of minutes for questions. Who wants to ask Steve or Jim something about our topics here? Yeah, please.
The question is with respect to best practice sharing. In the case of Carlyle, you've got the ability to pull from different sectors, different regions around the world. And Stephen, in your case, this hybrid of activism and private equity, things like board seats and sort of board chemistry, I'd be curious of best practice comments there.
On board? So on boards? Yeah, okay.
Well, best practices, we're still a small enough firms in terms of people that we all know what each other are doing and are constantly trying to learn as an organization. So we're not siloed where there's a team in Singapore doing a great deal and no one knows what they did, or making a mistake and no one knows what they did. We're constantly learning as an organization. So there's a constant focus on best practices, and we try to get it out to our companies. If we know a best practice, we formally get it out there, but it's just more of a learning as we go as a group of people working together.
One more quickly, and then we'll get the hell off stage. Anybody? Yeah.
Hey guys, thanks for taking my question. My name's Jack. I'm a reporter with the China Daily USA. So you'll pardon me that that my question's a bit self-serving in nature. But one of the things that I was curious to hear your thoughts on briefly, and I'm sure you could talk about it at length, this is a global panel. I'm curious if you guys could talk a bit about where China's perspective comes in here. You've talked about things like increasing transparency, increasing corporate governance measures. Where do you guys see China's role, not only in terms of the deals affecting that, but also helping push that forward, if you will?
Well, Jim, since you're the one in China, I think that one has your name on it.
Great.
Well, let me start. I think China's role is increasingly participative in all aspects of our business. Certainly as an LP, CIC is a very, very valued LP, and there are others out of China. We have had a very active investment practice in China. We have several offices on mainland China and then a Hong Kong office. And I think we've probably been about as active as any of the Western firms. There's been an emergence of local Chinese funds and investors, which is not at all surprising, and some have been doing very, very well. We actually sold one of our portfolio companies a few years ago, AMC Movie Theaters, sold it to the Dalian Wanda Group, which was the largest Chinese investment in the United States at over $2 billion at the time. So I see really a sort of a full spectrum integration of China in the global capital markets generally, but certainly within our private equity world.
When you're selling companies in China, it's not your grandfather's LBO shop. It's a different business. Jim and Steve, you are best practices in all three buckets of my own experience. Your friends, your colleagues, your clients, you're terrific. I can't thank you enough for making time in busy days to come and talk to our conference. Thank you.
Thank you very much.
A pleasure. Thanks.
Thanks a lot.
Thank you, Steve.